Thanks for the intro and setup there, Carl. We'll definitely do our best to unpack it, but no promises on making it less confusing. Anyway, just jumping right in, we've got 600 pages to cover in 30 minutes. So luckily, our Congress has simplified things for us, so it should be relatively easy. Before we jump in, though, we need to get some information from you so we can kind of tailor the conversation a little bit. So if everybody can pull out their Android phones, I'm sure you all have one, and navigate to summitcpa.cnf.io. And on there, we'll have some polling questions. The biggest thing to point out there, too, is in the bottom, there's a Q&A section. So if we have time, we'll circle back around, and we'll try to address those questions, or we can meet up afterwards. So feel free to use that area. Go back there.
While we're waiting on that, by a show of hands, what's the threshold of when you really start caring about a financial decision? $1, $10, 100, 1,000, 10,000, 100,000. So we're going to start talking about some big dollars here. So just get pumped. Everyone got in there?
Yeah, thanks for bringing out the cookies, Carl, and getting everybody amped up. We're going to need it. So let's start out with the first question. What type of entity is your business? So you should have a few options there. We'll see them loading on the screen.
You are too smart for this presentation with a question like that.
Mark both. No, you're an S Corp. Just pick your favorite one. Okay, so it looks like we're...
Yeah, a lot of S Corps. LLC is good.
Yep, a few C corporations. So next question, what is your share of the company's net income plus salary? So in salary, we also mean your spouse's salary. So think about W-2s that your spouse might have, the W-2 that you get received from your company, or the earnings if you're an LLC, and then add the net income there. Everything's...
All right.
Yep, looking pretty good. All right.
Hopefully this will drive some of our conversation as we go through this, because these thresholds are going to become important with this new tax law.
Yeah, I'm going to turn it over to Dave, and he's going to pull up Carl's tax return, and we'll use that as an example to go through.
Very good. So what the heck happened on December 22nd, besides having a lot of Congress people, or half of our Congress people, saying this was the best thing for the country? For all of us in the tax world, this was a pretty significant event. Biggest change in 31 years, 600 pages of new tax code that we got to go through. So this was pretty awesome for us. They said it's simplified. We want you to file your taxes on a postcard. Now, you and I call bullcrap in this group, especially with all the S Corps that we have in here. Not simplified for us. Individuals and C corporations, it's pretty simplified, pretty straightforward. You have lower rates, so it's just arithmetic from what you've been doing in the past. Flow-through entities, those are your LLCs, partnerships, and S Corps that you put on the poll right there. Not straightforward, and it's because of this new concept called for this group, I'll call the 20% deduction, which is a way that you'll be able to deduct 20% of your business flow-through income if you qualify. I wish it was that easy, but we're going to get right into it. So, major change, 20% pass-through deduction. It changes the way that we look at traditional tax planning. So, how did we used to do it? 15 years ago, you had $72 in your pocket, a new MacBook Pro, and you're saying, I am going to create the best digital agency ever. And you go to your in-laws. and you tell him about this dream of what you're going to make, and he said, you should go to your accountant. So you go to your in-laws accountant, and they say, you need to be an S Corp because I am going to save you a whopping $2,200. And back then, you're like, I need that money, big time. So that's how it worked in the past, and 15 years later, you're still an S Corp. Is that the right thing to do? Well, now we have to revisit what's happened. So, I'm an accountant, not a designer, but here is a chart that I hope you guys can read. So now under this new tax law, and I want to reiterate, we start at the top tax rate. So if you're over $600,000, I kind of have to start there just by saying, what are the rates under this new law? And what we analyze is, under a C Corp, a flow-through, or one of these new flow-throughs that gets the 20% deduction, how much are you going to be paying, business-wise and on the individual level? And right now, what are you picking? I'm going to be a C Corp. But this assumes that you are the most astute business people and are retaining all that money in the company and never pulling dividends out for yourself. But you guys work really hard and maybe want a vacation, a new Corvette, something like that. So what are you going to do? You're going to pull out some money. When you pull out money of a C Corp, you create dividends. And that's that double layer of taxation. So now the equation has changed. Now being a flow-through entity is the best bet.
Well, and there's an important distinction here because we do hear a lot of people saying, hey, maybe I should convert to a C Corp. And, and for bigger corporations, for publicly traded companies, they don't have to worry about that red section because whenever they give out dividends, they're passing it out to all of the thousands of people that bought a little bit of their stock. But as closely held businesses, that's our money. That's our Corvette money. That's our, how we've done our salaries. And so if you're not leaving that money in the business, that is a huge, you really do have to take into account the double taxation.
But I'm guessing most of us in this room, we're not pulling out every dime of profit. Maybe just a little bit. So what happens? That red section starts floating up and down year to year. And then what happened to our rates? We're starting to get a lot closer. So this analysis that we go through for our clients, it's just not that easy. And there's some things that a spreadsheet can't capture. And we'll go through that. So the bureau community. Most of us are flow-throughs. We saw in the poll a lot of S Corps, a lot of partnerships, a lot of LLCs. Don't know how they're taxed, but that's a flow-through entity. Your goal is going to say, I want to maximize this 20% deduction. That is where your major tax savings are going to come, starting in 18. But, of course, it's Congress, it's taxes, it's not that simple. So there's 3 variables that are going to impact if you can take the full 20% deduction. How much money does your company make? How much money does your spouse make? How much money are you taking as a wage or a guaranteed payment out of the company? Whether or not you're a specified service business. This one sucks, but we'll talk about it. And then also what entity type you're in. So again, whether the S Corp, partnership, LLC, there's different rules on if you can claim that full deduction. So let's look at our first one. Total family taxable income is under $415,000. You're good. You get to claim the full 20% deduction. There's a little speed bump in there at $315 where it starts shrinking a little bit. So let's run through an example. You pull out $150,000 of a wage from your agency. Then your agency flows through on your K-1 another $150,000. We're at $300 total taxable income. If it's just you, great. It doesn't matter if you're a service business or not. You get this new deduction. You're going to pay lower taxes. That's nice. But your spouse perhaps makes $75,000. Well, now you're at $375. Because I hit that $315 speed bump, my deduction starts getting phased out. So this is one of those, how many people in this room played the whole trick, in the whole month of December, you go on vacation and just happen to never get the mail and deposit your checks? Yeah, I swear, IRS, I was gone all month of December and just happened to go to the bank on January 2nd. No, but that's important now this year is because this is a year-to-year analysis of what my income is going to be to see if I qualify for this deduction. So each year, I'm looking at if I'm at that 315 to 415 range, so that checking out our income each year is going to be quite important. Next is the specified service business classification. Okay? So if you are in one of these fields, you are completely phased out of the 415. So, is Gabe here? The attorneys? He's screwed. Adam? Screwed.
I don't make enough, so
No,
that's okay.
But doctors, performing artists, things such as that, they get completely phased out. But somehow engineers got this great exemption from this phase out. And it goes back to a little bit, there was a deduction called the domestic production activities deduction. I'm getting kind of nerded out here. But anyways, they were able to claim this deduction that went away. And they lobbied really hard to say, we want to take this 20% deduction. So, are you guys engineers?
Shake your head up and down.
Yeah.
I'm a financial engineer.
I am now.
Yeah. We're all engineers.
Yes. So, well, can we please define engineer? You want to go through? Did the IRS? Oh yeah, the IRS gave us guidance. Engineering services in connection with any construction project include professional services requiring engineering education, training, and experience in the application of special knowledge of the mathematical, physical, and engineering sciences to those professional services such as construction, whatever. So there is very limited guidance in terms of if we can say this is an engineer or not. So let's go through what you guys are in this room if you are an engineer. SEO and SEM shops? You an engineer? Boy.
That's right.
I wish it was that easy, but that one, I mean, that was kind of, that one's close, and we're thinking.
Yeah, that'll be tough.
That was tough. SaaS companies. Well, SaaS companies, we used to take that deduction that engineers used to take for building things and selling them. The IRS said, the economy's changing, so we are going to let SaaS companies take that deduction for software development. If it was last year, then you know what? We're going to say, yeah, this year, yeah, you're engineer. Software development, yeah, you're engineering. Website development, coding, yeah. What about design? I don't want to say it, but kind of, yeah, no way. They're probably going to argue it's more aesthetic versus the actual building and then selling. And I know what you guys are thinking right now. Wait a second, I'm just not in one of these buckets. What if I'm design and development? Carl, I know you had us come here and talk about this, but I just have to say, I don't know. There is actually extremely limited guidance on what happens if you are a multi-service line business. The IRS has said that they are going to give guidance on what to do in the summer. I hope they address this. But here's what I'm thinking they're going to do. They're probably going to say, you got to split your books up between the revenue that you make from design and the revenue that you make from development, and then you can extrapolate that to calculate what your deduction is going to be. So I hope that's what it is. That's probably the easiest way to do it. Adam's talked to a couple people where they're saying, oh, maybe I need to split my company into two.
Right.
That's getting dicey, and that's a lot of attorney fees.
Yeah.
So we've had several questions from our clients is, okay, C Corps get this nice flat 21% tax rate. It's a heck of a lot better than the 37% I'm going to be paying now under the new law. So do I change to be a C Corp? If you're a smaller shop with income that's consistently under 315, I don't do it. You're going to automatically get that 20% deduction. Okay. There is a deadline of March 15th if you do want to convert to a C Corp, so there might be some homework. So have it apply for the entire 18 year.
No, that's net. Yeah, and keep in mind an important distinction there too is that applies to the individual. So if you have multiple partners and that number and your net income from the business is $600,000 and there's 3 of you, then it's really only $200 each. So that's right. An individual number that you're looking at.
Yeah. That's
right.
correct.
Yes.
Yep, so your tax return is going to change in 18 on how you calculate this deduction for sure. Okay, what do we got? So I know, and another sexy chart. We love spreadsheets. So don't worry about all the data. We're looking at the bottom line right here. So what we were looking at is how are flow-throughs and C Corps taxed now under this new law. And we're going to focus on a couple things, but up top there man, I wish the spreadsheet could capture everything, but it's not. But if you're in a company that's wanting to keep cash, build your reserve, keep cash back because I have all this growth, well, that means I'm not paying out that dividend. So what happens if I have a $400,000 net income, I'm better off by $1,000. I didn't see many hands for $1,000 that were people were too worried. What if I jump up to the $600,000 net income? Now I'm looking at about $23,000. If I'm $1 million in net income, I'm saving about $77,000 per year by converting to the C Corp. There's a couple of factors. The state taxes I know you wanted to talk about, yeah?
Yeah, the biggest thing is this isn't all-encompassing. There's like a lot more things to go through. One note and one change on your personal taxes, and I know a lot of you in Oregon and California and New York are feeling the pain of the changes of no longer being able to deduct all of your state income taxes. So there's a cap on that. The one nice thing about the C Corporation is you'll be able to deduct those state taxes at the corporate level. And so you don't have to worry about that phase out or that haircut that they give you on your long form. So that's not built into this, and it would actually make this look a little bit nicer, a little bit more appealing to be the C Corp. But again, keep in mind that these are, in these scenarios, if you have multiple partners, you just make sure you divide that income out. So for most people, a lot of people are not going to be hitting these numbers that yield the bigger results here.
Mm-hmm. But if I'm hitting that cash reserve and I start paying out myself a small dividend, that layer of double taxation starts coming back into play. So my smaller shops with 400 net income at the individual level, it's better to be the flow-through. But as the income grows, I still have the benefit. What about if I'm for sure an engineer and I'm going to be getting this deduction? Right now it says you want to stay as a flow-through because you're going to get that 20% benefit that was a part of the new law. So a lot of red there by saying you might want to hold off on converting to a C Corp there. No one's fallen asleep yet? Okay, good. So we're going to make you sound really smart when you go and sign your tax returns this year. And we got some questions for you to ask your accountant. If you're an agency with multiple service lines like we talked about, make sure your bookkeeping is set up to record that split activities between the design and development. You probably should be doing it anyways right now, just so you can track the profitability each one there. But for actually claiming the deduction, having that bookkeeping set up is pretty good.
Yeah, no bright line there, but historically that has been important on the other flow-through deduction that he was talking about before. So we assume it's going to fold out the same way.
S corporation, I can talk about this one. Yeah, so if you're an S corporation, you got that whole salary that your accountant says you have to pay yourself. And the goal has always been you want it to be as low as possible. And now the motivation is even more there. Because then you're subjecting more of your flow-through income instead of the wages to the 20% deduction. Old rule still applies. You can't pay yourself $12,000 per year and then be ripping out $150,000 of dividends. That's against the reasonable wage component, but talk to your accountant, see if you can revisit how much you're paying yourself. Partnership?
Yeah, on the partnership side, guaranteed payments, similar to salary. This one, you don't have to worry about reasonable comp. You can lower your guaranteed payment, shift more income to the business income so you get a bigger deduction. The challenge that you're going to run into, again, I'm going to bring up multiple partners. Generally, that's how, unless you have partners all making the exact same thing and have the exact same ownership percentages, manipulating this can be difficult because this is oftentimes how we counterbalance who's doing what work. So that's the challenge there.
But if I can shift $100,000 of guaranteed payments to distributions.
It's $20,000.
$20,000.
Yep.
So you might want to make those conversations important with your partner. Adam, you can talk on this one.
Yeah, I mean, I've been advocating this for years. I know for the B Corps in the room, this is super important to make sure those charitable contributions are in there. But the biggest thing is that as a business, whenever you give to a charity, that money is separately stated on your tax return, and it flows to the individual return. And then it goes into that long form that you file, and it potentially gets used or not used. What we know about what they're changing is they're trying to eliminate the spot where that was normally deducted. So just keep in mind that whenever you go to make those charitable contributions, if there's an opportunity to make it a sponsorship and shift it into the marketing budget, you definitely want to try to do that.
Our lunch conversations were kind of fun. We got some pretty creative people here about how they classify things. So it is important. Meals and entertainment aren't as fun as they used to be. Entertainment is gone. So those Final Four tickets you bought, took your customer to, no longer deductible. This one is kind of pinging like the Facebook and Apple cafeterias where you can go down and have lunch every day. Well, those meals are now 50%. So your beer cart in your office, that's now 50% deduction. When you take us out to dinner, that's still a 50% deduction that you can write off.
We'll throw it in office supplies. It's 100% if you take Dave and I. But
okay. The office supplies is just growing. I can see what's going on right now. And also, I kind of saw some conversation on Slack about research and development tax credits. Thank goodness Congress did not touch these. We've actually gotten a lot of traction in this community on being able to claim R&D tax credits. Marty talked about it. You know, he had, what was it, like 30% of his company's time were innovating on this new stuff. Well, Congress put this into place so you would hire people to develop new products, new technology. I mean, that's why they put this in play here. So it's a good way to, let's look at those activities that you're not getting paid for, and you can get a nice little bump on your tax return by claiming the R&D tax credit. So
yeah, a couple big things there, though, too, is it's not just external stuff. So you don't have to be building a product. If you're building some internal tools, the IRS has given some guidance over that the last couple years. So that's huge for you. I got a lot of clients that are able to take advantage of that. The other thing is that you're now able to also offset your payroll taxes. So if you're in a situation where you're not making very much money, you're not getting the credit on your individual return, you're able to offset your payroll taxes on your employee wages and everything, which is also a huge benefit.
Yep, very good. So I asked Carl for 8 hours to go over all 600 pages, but he declined. So that wraps up our presentation. We're going to post the slides to the Slack channel, but I do put my Calendly link up there. It's quite a busy time for me, but I got 15 minutes for you. So ping me, find a spot, 15 minutes. We can go through the spreadsheet that we were looking at, like the S versus C Corp analysis. We'd be happy to share it with you. But all in all, it was great to meet so many new people, and you survived the tax talk.
Well, we've got just a couple minutes here, and there was a question regarding consulting in advance of a development project. Is that considered engineering, or is that a specific other category?
Consulting.
Yeah.
Someone I saw was putting up, they said, we would love bright lines, but here's not a bright line. They said, if you called in sick, would you be able to make money? So if you didn't show up, you're not taking the calls, then they're saying, well, then you probably aren't engineering, or it's more of a service.
Yeah,
that's a great question.
Yeah, it'll be a little difficult. I mean, it'll probably run more on the service side whenever we go to do the split.
Mm-hmm. Yep. And there's one other thing that he didn't talk about, but there's also a blanket statement that the IRS put in there was, if the work is due to the primary skill and reputation of your employees, then it's also a service. But man, that's so broad, and I'm going to quit talking about it because we just don't know enough about it.
Right.
They haven't given guidance.